After years of resilience, the US dollar has been showing signs of fatigue for the past few months. Its decline accelerated since the start of 2026, and markets are now beginning to look beyond interest rates for explanations. One structural theme coming back into focus is the US twin deficit, heavy government borrowing alongside a large external financing gap. This isn't new, and history shows that when these imbalances persist, they can shape multi-year dollar trends. How have twin deficits influenced dollar weakness in the past? And what role do policy choices, trade dynamics, and monetary decisions play in turning those imbalances into sustained currency moves? Well, to answer these questions, I'm joined today by StoneX Director of Market Strategy, Vincent Deluard. Thank you for joining us, Vincent.
Thanks, Fiona. It's a pleasure to be here.
Vincent, before we get into history, let's start with the basics. I alluded to it in the introduction, but could you tell us a bit more about what economists mean by twin deficits? And more importantly, why do they matter to the US dollar specifically?
Right, so the twin deficits refer to the current account deficit, which is the sum of the U.S. exports minus the goods and services that the U.S. imports. So that's what we call the external balance. And the other deficit is a fiscal deficit. And that's basically the government balance. A lot of that came into focus in the early 2000s. That's really when we had this kind of long dollar weakness trend on the back of what at the time felt like a large deficit on the fiscal side. It was around 3%, which would be quite nice to have now, and a growing current account deficit, and that corresponded to a really sustained fall in the dollar. I mean, if we look at the euro, I mean, I think that the peak was basically a halving almost from 0.8 to 1.6. This was when the British pound went to 2 against the dollar. Even the Brazilian real was a strong currency back then. So that's the original period. Now, why they matter? They matter for every currency in general. I mean, if you run a deficit, you are sending your currency abroad. So you're selling more dollars than people want to buy. Now they can be offset, and they are offset from an accounting perspective by the financial account. By definition, if you buy more from the rest of the world than you sell to them in goods and services, you must be giving them something in return, some claim, either claim on your future income, which has a debt obligation, or foreign direct investment.
And the modern dollar era really begins after the collapse of Bretton Woods in the early 1970s. How did twin deficits contribute to dollar weakness in the 1970s after the US left the gold standard?
Well, for a long time, the U.S. was a surplus country. I mean, after World War II, the rest of the world was devastated, and I mean, one of the big problems that the U.S. had was that we had a surplus on everything, and other foreigners had no way of they wanted to buy things from us, they just couldn't procure the dollars. Which is why we had things like the Marshall Plan, which was a way to deal with the persistent surpluses of the dollar, of the U.S. economy, and provide Western Europe and England with dollars in order to purchase these goods. And I guess it's the curse of success. The Marshall Plan was very successful. Japan and Western Europe industrialized very quickly. And after a while, these surpluses, U.S. surpluses, started to melt as European industry recovered. Japan started having a current account surplus, and then we had the exact opposite situation where it was the rest of the world that was accumulating claims on the U.S. economy. Now, at the time, of course, this was the Bretton Woods architecture was the only the dollar was convertible to gold, and all other currencies were convertible to a dollar at a fixed exchange rate. So countries, including especially France, were accumulating a lot of dollar, and they could see how that their piles of dollars were growing, and at the same time, the gold in Fort Knox was not. So they could very rapidly understand that the system would break at some point. The parity, which I think was $35 an ounce, would have to break. It's actually France that caused that run on Fort Knox by demanding its dollar holdings to be converted into gold. I think we even sent a warship, French warship boat in New York. I don't know what we were going to do with it. But yeah, the French got a little bit of their money, and then the Germans wanted to do it too. And that's when Nixon and Volcker and a couple other folks at the Treasury, I forgot the name now, decided to change the system. There's a fantastic book on that. It's called 3 Days at Camp David. Basically, complete change. Sorry, we can't really gold for dollars. We're going to go floating exchange rate. That created a lot of the volatility and the system that we live in now, where basically exchange rates are floating, and we don't have this kind of adjustment via gold balances.
And one of the most cited examples of dollar weakness is the period following the Plaza Accord in the mid-1980s. Why did twin deficits become such a powerful driver of dollar weakness after the Plaza Accord?
So, I don't think the twin deficits were the primary reason for dollar weakness. You know what? So what happened before the Plaza was that we had this great inflation in the 1970s. Paul Volcker steps in, raises, decides to control the money supply and let interest rate rise to ungodly level. I mean, almost 17% overnight. And at the same time, we had the shock, fiscal shock of the Reagan election, the Star Wars program, big fiscal deficit. So we have a very strong dollar policies, high interest rates, which would suck in capital from the rest of the world, and at the same time, big deficit stimulating growth. So the dollar really takes off. And the Plaza Accord was meant to correct for that. Basically, the Ronald Reagan called the finance ministers of Germany, France, and Japan, locked them up in a room in the Plaza, which at the time was owned by Trump. I think some of if you want to understand Trump, I think people's memories are formed in their 20s or 30s. I don't know how old he was back then, maybe probably more 30s, but he remembers that this kind of like strong arm techniques, and basically told them, well, you're not going to leave this room until you agree to revalue your currency, or you're going to get a big tariff. So again, very Trumpian strategies. And then the Japanese, the German, and the French agreed to revalue the franc, the mark, and the yen. And again, it's one of these cases of the curse of having what you want and even more. We wanted to weaken the dollar, and the dollar weakened dramatically. This is when the yen really went through the roof. When we had the big bubble in Japan. At the same time, German growth was picking up. So it became kind of self-fulfilling circle. And then, yes, to some extent, I mean, the deficits played a role because this was the start, I mean, of the era of the big deficit in the U.S. I mean, that's why I was kind of hesitating at the beginning, because compared to today, look at the deficits in the 80s, they were actually quite small. There were some years when the U.S. even had a current account surplus. But yeah, it was the beginning of this transition for the U.S. from being a country with very high net savings to a country that started to import capital from the rest of the world, especially Japan and Europe.
Brilliant history lesson. Love it. Now, if we fast forward to the 2000s, we see that we don't need a formal currency accord to see the dollar weakening for years. How did the twin deficits contribute to dollar weakness in that sort of 2002 to 2008 period then?
All right. So again, it's always, with currencies, it's always multi-factor, right? You cannot just say this was this or that monetary. I mean, there were the twin deficits were big. Now, what's important to understand is that there is a bit of a it's almost an accounting identity. Like the twin deficits feed each other. I mean, if you want to run a big public sector deficit, which is what the U.S. did after 9/11. Remember, in the early 2000s, we had a surplus. I mean, this is the last in 10 years, there was all these theories that we were going to run out of US debt because we had so much surpluses. Now, of course, the world changes on 9/11. And we decided to start wars that cost a lot of money and gave very little in terms of return. Also, it was almost psychological, I think. There was this idea that if we allowed the US economy to enter recession, the terrorists would win. So this was, I think, also part of the thinking at the Fed. If you look at how quickly the Fed dropped the interest rate with 5.25 in 2000 and then went all the way down to 1%, which at the time was unheard of, I think it was excessive. But it was also because there was this idea that we could not let the US fall down. So we had this kind of excessive stimulus from both fiscal and monetary. And if you do that, you're going to boost domestic demand. That's going to boost imports. And that means that you're going to run a big current account deficit. So that's when really the twin deficit started to be a major theme. And they're not correct. I mean, you'd think over time that usually, nature is healing, right? The best cure for high prices. If the dollar weakens enough, eventually that will make U.S. exports more competitive and things will go back to balance. Well, it did not happen that way. A lot of that had to do with China, which was opening up, growing extremely fast, amazingly rapid gains in productivity, which meant that even as the yuan appreciated and also that the yuan was pegged to the dollar, so really we didn't let this process. In a normal world, it should have been that the dollar would have gone down, the yuan would have gone up, and the trade balances would have fixed themselves. But we did not let that happen, and the imbalances persisted all the way until the great financial crisis.
So we talked about loose monetary policy in the 70s. That's something you've already covered in several interviews on debt. And you just mentioned rates kept low following the dot-com crash. How does Federal Reserve policy interact with twin deficits to either reinforce or offset dollar weakness?
Yeah, I think you touched here a very crucial lie, I think, in monetary policy and its interaction with treasury and currency movements. Whenever you bring up a question about the dollar, and I think there was one at the last FOMC press conference, precisely because the dollar movements have been so brutal, the standard answer from every Fed chairperson since at least the 50s is the dollar is the Treasury cares about the dollar, the Fed only cares about domestic things. Now, how you set, when you see everything that the Fed does in terms of setting the overnight rate or balance sheet policy, of course it's going to impact the dollar. But we still live behind this kind of fig leaf that the Treasury is concerned about the dollar and the Fed is not. In reality, I would say that the Fed, the primary, at least short-term driver of currency movements are interest rates, and interest rates are set by the Fed. But it's kind of one of these big lies that everybody, it's like the king is naked, right? No one wants to say it. And yes, monetary policy contributes. And one reason for dollar weakness this year has been the expectation that we'll have a much more political Fed, that will have at least 2 or 3 cuts, while at the same time we are seeing the Bank of Japan slowly raise rates, and the ECB kind of keeping them where they are. So all else equal, monetary policy is contributing to this dollar weakness.
Finally, Vincent, let's bring politics and global trade into the picture. How do political decisions and global trade dynamics shape whether twin deficits become a long-term headwind for the dollar?
Yeah, I think it's also the perception of these deficits that matter. Like you can run a big deficit and have a strong currency. I mean, the U.S. has run a big trade deficit for 30 years now, and there has been periods of very strong dollar performance. And a lot of that has to do with the other side. Where you talked about the goods and service of the capital accounts. The other side is the financial account flows. So if money is trying to go into your country, more so than you push it out with your deficits, your currency is going to appreciate, and that has been the pattern in the U.S. for quite a bit. The past 3 years with the excitement over AI means that the deficits were irrelevant. Foreigners wanted to buy U.S. assets. Now, of course, if that confidence in the quality of U.S. institutions or the sustainability of U.S. growth starts to falter, you start to see these flows slow or even reverse, and I think we've seen a bit of that during the Liberation Day panic, and that's probably what forced the reversal in policy and the pause on tariff, and we see again a little bit of that in early January with foreigners threatening to sell U.S. assets, the dollar weakening. So this was more of a politically driven sell-off than trade flows or even monetary policy driven one.
So from all of what we've discussed, we can say that the dollar weakness is not about collapse, but more about gradual erosion. Would you agree?
And again, forecasts of dollar collapse have been there for a long time, and on a long enough timeline, the survival rate drops to zero. That's a quote from Fight Club. We don't use the British pound or the Portuguese escudos or the French franc or the Genoese currency. So there's been a long succession of reserve currencies that were discarded, and surely that will happen to the dollar at some point. But it's not the problem for erosion is against what? It's always the currencies are always a pair. So you can only go down if something else goes up against it. And I think that's what the market has been struggling with for a long time. In the early 2000s, there was a lot of optimism around the euro, its ability to increase its share of global reserves. That has faded away. Obviously now the candidate would be the Chinese yuan, but it's also a country with a closed capital account. You need an authorization from the Foreign Exchange Administration to move money in and outside of China, which basically means it cannot be a reserve asset. So we have this somewhat awkward situation where we don't like what we have as a reserve asset. Nobody likes it. Foreigners don't like it. Even the U.S. doesn't like it. If you read Stephen Miron's paper, it's very clear that he views a good share of the administration, I think, views the dollar's exorbitant privilege as a burden on the U.S. economy. Like we would like to not have the reserve currency, or would like at least to charge other people for using it. So nobody's happy with the current system, but there's nothing that really stands out as a viable replacement, which is, I think, one of the reasons why we see this, extreme volatility in gold, in crypto, anything that, and none of these solutions are good, which is why, for a while we get enamored with one of them, and then we realize, actually, crypto is not practical. And we had the same thing happen with gold and silver, and it is barbarous to use, the barbarous relic was what terms that Keynes used. It's not a very smart way to settle trade and financial flows in the modern economy. So it's not perfect. And that always leads back to the dollar. And I think that contributes over time to what you described as a kind of a slow erosion instead of a, sudden collapse.
Yeah. No, excellent. Well, thank you very much for your insights. Always extremely interesting talking to you, Vincent. Thanks for your time.
Always a pleasure. Thank you very much.
For more videos like this, please do like and subscribe.